Have you ever asked yourself why gold trading remains a popular choice in 2024? Well, the answer lies in the enduring value and allure of this precious metal. Gold trading is not a new phenomenon. It is, in fact, one of the oldest forms of investment, dating back thousands of years. The importance of gold in the global economy cannot be overstated. It's not just an ornamental metal or a component in industrial applications. Gold stands as a symbol of wealth and stability, a universal currency that transcends national borders and economic systems. But what makes gold a preferred trading asset? One reason is its rarity. Gold deposits are difficult to find and extract, making the metal a scarce resource. This scarcity contributes to gold's high value and makes it a sought-after commodity in the trading world. Gold plays a significant role in the forex market, where it's traded as a high-liquidity asset. Traders across the globe are drawn to gold trading due to its potential for yielding substantial profits. It's seen as a safe haven in times of economic uncertainty, providing a shield against inflation and currency devaluation. Furthermore, gold prices are influenced by a myriad of factors, such as central bank policies, the value of the US dollar, supply and demand dynamics, market volatility, and gold production levels. This interplay of factors makes gold trading a dynamic and exciting venture, requiring strategic decision-making and thorough market analysis. However, despite its potential for high returns, gold trading is not without risks. Like any investment, it requires careful planning, risk management, and a sound understanding of the market dynamics. So, whether you're an experienced trader or just starting out in the world of trading, gold presents an intriguing and potentially rewarding trading option. With its enduring value, rarity, and pivotal role in the global economy, gold continues to shine brightly in the trading landscape. Gold, with its enduring value and rarity, remains a key player in the world of trading. Central banks play a crucial role in influencing gold prices. These financial institutions hold vast reserves of fiat money and gold. The way they manage these reserves can significantly sway the gold market. But how does this happen? Let's dive into the world of central banking to find out. Central banks, as part of their reserve management strategy, often diversify their holdings. This diversification isn't restricted to different types of fiat currencies. They also increase or decrease their gold reserves as part of this strategy. Now think about what happens when central banks start accumulating gold. They are effectively increasing the demand for this precious metal. As the law of supply and demand dictates, when demand for a commodity increases and supply remains constant, the price of that commodity rises. This is precisely what happens in the case of gold. So, when central banks decide to diversify their reserves by adding more gold, they inadvertently push the price of gold higher. Conversely, if central banks decide to reduce their gold reserves, they increase the supply of gold in the market, which can lead to a decrease in its price. In essence, central banks have a dual role when it comes to gold. They act as significant market participants due to their buying and selling activities, and they also influence market sentiment. If market players anticipate that central banks are likely to increase their gold reserves, this expectation can drive gold prices up, even before any actual purchase takes place. The actions of central banks, therefore, can create a ripple effect in the gold market. Their policies and strategies can lead to changes in demand and supply dynamics, influencing the price of gold. So, the strategic moves of central banks can indeed impact the gold market. This is a critical factor for traders to consider when trading in gold, as the decisions of these financial powerhouses can create opportunities for profit or precipitate risks that need to be managed. Did you know that the value of the US dollar significantly affects gold prices? It's true, and the relationship between the two is a compelling dance of economics. While gold is a globally traded commodity, it is typically priced in US dollars. This means that any significant changes in the value of the dollar can have direct impacts on the price of gold. Let's dive a bit deeper into this intricate relationship. The US dollar and gold prices tend to move in opposite directions. This inverse relationship is due to the fact that a stronger dollar makes gold more expensive for buyers using other currencies. When the dollar appreciates or grows stronger against other currencies, the price of gold usually drops. This is because gold becomes more expensive for non-US dollar buyers, leading to a decrease in demand and therefore a drop in price. On the flip side, when the US dollar depreciates or weakens against other currencies, gold becomes cheaper for foreign buyers. This increases the demand for gold, which in turn drives up its price. The relationship between the US dollar and gold is also influenced by interest rates. Higher interest rates often boost the dollar, as it means higher yields for investors, which makes the dollar more attractive. This can lead to a decrease in the price of gold. Conversely, lower interest rates can lead to a weaker dollar and therefore higher gold prices. It's also worth noting that during times of economic uncertainty, investors often flock to gold as a safe haven investment. This can lead to an increase in demand for gold and subsequently a rise in its price, even if the dollar is strong. So it's clear that the strength of the US dollar plays a significant role in the price of gold. Whether the dollar is rising or falling, its value has a direct and often immediate impact on gold prices. Therefore, the strength of the US dollar can guide gold prices. It's a fascinating dance of economics, one that every savvy trader should be aware of. It's all about supply and demand, even when it comes to gold. The dance between supply and demand is a universal principle that governs all markets, and the gold market is no exception. In this scene, we delve into how this fundamental economic law influences the prices of this precious metal. Demand for gold is multifaceted. On one hand, there is industrial demand. Gold, with its excellent conductivity and resistance to tarnish and corrosion, is a crucial component in electronics manufacturing. As our reliance on technology continues to grow, so does the demand for gold in this sector. On the other hand, there's consumer demand. Gold is a symbol of wealth and power, and people around the world purchase it in the form of jewelry. Countries like India and China, with their strong cultural ties to gold, are major consumers. In India, gold is not only used for adornment, but also plays a significant role in religious and social functions. China, with its rapidly expanding middle class, is also a major player in the gold jewelry market. Then there's the United States, another significant consumer of gold. The demand here is driven not just by jewelry and industrial use, but also by investment. Gold is often seen as a hedge against inflation and currency fluctuations, making it a popular choice for investors. On the supply side, we have gold mining. The amount of gold that gets mined each year can also affect prices. If mining activities increase, the supply of gold goes up, potentially driving prices down. Conversely, if mining activities decrease or if existing mines start to run out, the supply of gold could dwindle, pushing prices up. In essence, the interplay between supply and demand in the gold market is a dynamic, complex dance. It's influenced by a multitude of factors, from technological advancements and cultural traditions to economic instability and investment trends. As with any commodity, the balance of supply and demand plays a vital role in gold prices. In times of uncertainty, gold shines the brightest. This adage is not just a poetic sentiment, but a practical reality in the world of economics and investing. Gold has long been considered a safe haven in times of economic turbulence. It's a physical asset, tangible and finite, unlike fiat currencies, which are subject to inflation and can be devalued by governmental policies. Gold's enduring value is in its rarity and its universality as a symbol of wealth and stability. When economic downturns occur, investors often flock to gold as a protective measure. Stock markets may fluctuate wildly, businesses may collapse, but gold remains. It is not subject to the same whims of consumer confidence or market speculation. It holds its value, and in times of economic stress, that value often rises as demand increases. This is not just true for economic downturns. Political instability can also drive the demand for gold. In periods of geopolitical unrest or uncertainty, gold is often seen as a safer bet than volatile currencies or other forms of investment. This is because gold is universally accepted and isn't tied to any particular government or economy. The appeal of gold in these situations is its stability. While other investments are swinging wildly in value, gold tends to be more steady. It's a port in the storm, a place to park assets until calmer waters return. This stability often makes gold a popular choice for portfolio diversification, providing a counterbalance to more volatile assets and helping to mitigate potential losses. However, it's important to remember that while gold can be a safe haven, it's not immune to fluctuations. Its value can and does change, often in response to the same factors that affect other investments. But on balance, it's considered to be a less risky choice in times of economic and political upheaval. So whether you're a seasoned trader or a novice investor, consider the role of gold in your strategy. As we've seen, it offers potential protection in turbulent times, serving as a steady hand in an often chaotic market. Gold is a beacon of stability amidst market volatility. Gold production, it's a game changer in gold pricing. Just like any commodity, the law of supply and demand applies to gold. The world's gold supply mainly comes from mining, an industry that has seen fairly stable output since the year 2016. However, the production of gold is not as straightforward as it may seem. The cost of mining gold can greatly influence its market price. Think of it this way: as the costs associated with unearthing gold increase, so does the price we pay for it. And these costs are on the rise across the board, from labor costs to the price of the machinery used in the mining process. The quality of ore, the rock from which gold is extracted, is also a crucial factor. Over the past few years, the quality of ore has been on a steady decline. This means that miners are having to process more and more rock to extract the same amount of gold, leading to increased production costs. Another factor to consider is oil production. That's right, oil. You see, the gold mining industry is heavily dependent on oil. From the machines that dig up the ore to the trucks that transport it, oil is integral to the process. Therefore, as global oil production begins to decline, gold production is negatively impacted. This in turn drives up the cost of extracting gold and can lead to higher gold prices. In essence, gold production is a complex network of factors, all of which can influence the price of the precious metal. From mining costs to the quality of ore and the availability of oil, each element plays a crucial role in determining the final price of gold. The complexities of gold production, therefore, have a significant say in its pricing. The takeaway here is that gold is not just a shiny metal. It's a commodity whose value is derived from a multitude of interconnected factors. So, how does one trade gold in this dynamic market? To trade gold, you need to understand the process and the importance of price movements. Gold trading is, in essence, speculation on the price of gold. Traders make a profit by buying gold when the price is low and selling it when the price is high. First, you need to understand what moves the price of gold. As we've mentioned earlier, several factors influence the price of gold, including central bank policies, value of the US dollar, supply and demand, market volatility, and gold production. Keeping an eye on these indicators can help you predict price movements and make informed trading decisions. Once you understand the factors that influence gold prices, the next step is to choose your trading instrument. There are several ways to trade gold. You can buy physical gold, but this method is cumbersome and involves storage and insurance costs. Alternatively, you can trade gold derivatives such as futures and contracts for differences, or CFDs. These instruments allow you to speculate on the price of gold without owning the physical commodity. Futures contracts are agreements to buy or sell a specific amount of gold at a predetermined price on a specific future date. These are traded on futures exchanges and are popular among professional traders. On the other hand, CFDs are agreements to exchange the difference in the price of gold from the time the contract is open to when it is closed. CFDs are traded on margin, meaning you only need to deposit a small percentage of the full value of the trade to open a position. Another way to gain exposure to gold is through gold mining stocks. These stocks are correlated with the price of gold. When the price of gold rises, gold mining stocks often rise as well. Remember, no matter which instrument you choose, it's important to have a sound trading strategy. This includes setting your entry and exit points, managing your risk, and regularly reviewing and adjusting your strategy based on market conditions. Remember, understanding the factors that drive gold prices is key to successful gold trading. Let's take a moment to recap what we've discussed about gold trading in 2024. We've delved into the enduring importance of gold trading, highlighting how this precious metal has become a popular asset due to its inherent value and rarity. We've examined the role of central banks in influencing gold prices as they diversify their reserves between fiat money and gold. We've also explored the inverse relationship between the US dollar value and gold prices, a dance of demand and value that affects global gold trade. Our journey took us through the dynamics of supply and demand, the impact of market volatility, and the influence of gold production on prices. Finally, we've offered a glimpse into the basics of gold trading, arming you with the knowledge needed to navigate the nuances of this market. Armed with this knowledge, you are now better equipped to navigate the golden seas of gold trading in 2024